It's Brian Preston, the Money Guy.
All right, Brian, this next question, this is from Richard. Richard says, my wife and I are starting an HSA, a health savings account, and we want to max it out. Question, should we invest everything we put in it, or should we save some to cover the deductible? So somebody's hearing this question for the first time. Perhaps it makes sense to talk about what HSA is, how it works, and specifically why Richard recognizes he is in a unique portion of the population that knows about investing it.
Yeah, we like health savings accounts. If you go and check out our financial order of operations on moneyguy.com/resources, or even if you go into our deep dive through the course at learn.moneyguy.com, you'll see step number 5 is going to have tax-free growth accounts, and one of them is health savings accounts. We love these accounts because they are triple tax advantage. When I say triple tax advantage, you get a deduction on your contributions. They grow tax deferred. And if you use them for qualified medical expenses, you will get to pull that money out completely tax free. That is really powerful stuff. There is a little bit of a catch. You have to have a high deductible health plan. It has to actually be an HSA eligible high deductible plan. That's something you can always ask of your employer, or if you're shopping on an exchange, you can look. Usually that's a box you can check in the filter to see if it's HSA eligible. And why are these plans structured? Why did the government create special rules for high deductible health plans? Is that they want you to be involved in your healthcare decisions. So typically the way this works is with a high deductible plan, just like the name implies, it will require you to have skin in the game or money through paying a deductible before the health insurance actually kicks in. I joke about the fact that most insurance these days is really just a big discount card, because they're going to run it through insurance. They're going to discount it. You don't actually get to use health. Your insurance company isn't going to start writing checks for you until you put money in. So there's a chance. There's a few people out there. Maybe you're in the having children stage of life, or you have medical, ailments or things or struggles that you have high annual expenses, that maybe the PPO at your employer is actually better than the health the high deductible plan. But for a lot of us, and it sounds like this is Richard, he's trying to figure out, hey, how do I take advantage of this? This is, it's a really good situation in the fact that you do get that tax deduction, but this is what Bo was alluding to. 96% of people who have health savings accounts use them as clearing accounts, meaning that you put the money into the account, you take your deduction for the contribution, but then your expenses for that year, medical expenses, you pull the money right back out. Well, you took advantage of one of the 3 triple tax advantage. So you hear that. Is 94%. Did I get that right first? Because it's 6%.
Yeah.
Because it was 4%.
Only 4% of folks actually do it.
So 96% of people are putting the money in, pulling it out, only getting the tax deduction. Meanwhile, that 4% are taking advantage of all 3. And Richard's saying, hey, where does that crossover point come into play? And I always say I do think people should keep enough cash to basically cover those deductibles. Sure. So, figure out what your deductible is in the plan. Also figure out what your out-of-pocket maximum is, just in case you had some big, huge medical thing happen, so you don't get caught swimming naked when the tide goes out. That's always a risk. But once you get that basic level of the deductible and understand where the out-of-pocket maximum is, let's put that money to work. Yep. That's what we have told you. We take advantage of that 4% part, is meaning that I am loading it up. I love that some of the big providers have gotten into health savings accounts like Fidelity Investments and others, where you can go open up an account, make sure you're keeping enough cash, but then start buying some index funds, and other things to think long term, so you can get that tax deferred growth and then that tax free, withdrawal once you're using it for qualified medical expenses. Because in retirement, medical expenses are going to be high. You will need the money. Take advantage of this stuff.
I'm even going to go a step further. Even if medical expenses aren't high in retirement, let's say for some reason you're just like super, super healthy, but you had medical expenses when you were younger and you're accumulating that, you're basically just boosting your tax-free dollars because you get to reimburse yourself for past expenses. I'm warming to this idea. I think the HSA might be my favorite type of saving. You know, it used to
Even
be
over Roth
I think
IRAs.
I like it over Roths.
Yeah.
I think I like it over
That's
Roths.
pretty powerful.
Because of all the advanced flexibility that you have with it. Now, here's another little thing. If your employer allows you to deduct it from your paycheck, like make your contribution, it's actually quadruple tax advantaged because then you can save on some payroll taxes
Very
with
true.
that as well.
Well, you could actually say Cinco tax advantage because
Quinta
and the
tax
fact that you can also use it as a retirement fund. You still have to pay income tax on the earnings, but if
accrued
once you're over
tax-deferred retirement
65,
fund.
you can use the money for retirement expenses. I
love
mean,
it.
just for anything.